Sold at 560.
785 the first, 785 the second, be sure, 785 the third, the final time, sold. The third and final time at £910,000, sold. Welcome to the Allsop Prop Chat. This is the series of podcasts designed to cover the interesting aspects of property. We're going to be covering all sections, starting with the commercial auctions, and we'll go through residential, commercial and build-to-rent sections as we progress throughout the year. So welcome to this edition of the Allsop Prop Chat podcast. This is going to cover the March 23rd auction. My name is George Walker. I'm partner and auctioneer in the commercial auction team. I'm today joined by two colleagues, familiar faces I'm sure to some of you, those who remember the auction room. First of all is Ben Hodge.
Hi George, thanks for having me. You might remember me from the auction room asking you buyers surveys questions.
Excellent. And my fellow auctioneer, Will Clough.
Thanks for having me, George, and certainly looking forward to getting back on the rostrum when regulations allow.
Excellent. Well, thank you very much. So, 23rd of March, the anniversary of our first online auction. Interestingly, we raised double the amount of that day. We raised £54 million against £27 million last year. Hardly surprising, last year was a bit subdued, but we built up a really good system this year. And thank you everybody who's gone with us over the period of 12 months and created quite a positive journey for us. The auction was interesting, dominated by a couple of portfolios, Boots and Santander's, which we'll come on to. As always, with Allsop's auction, we had some variety there. We had a really lovely building in Crawford Street, sold for a couple of £1 million, all the way through to a bank in Musselburgh. And again, we'll go into the detail of that later. We all cover different bits of the auction. So Ben, can I ask you to cover your first bit, the shopping centre, Dumfries?
Yeah, thanks, George. As you'll be aware, we sold a shopping centre in Coventry in February in our February auction, and it went very well. On the back of that, we got instructed on the Lawburn shopping centre in Dumfries. This was a town centre shopping centre with all your sort of household names in it. Good tenant mix. We saw some good demand, and this sold before the auction, above the guide, with some good demand there.
So Ben, just run us through how much rent was it, number of tenants, that sort of stuff.
So the rent roll was around £850,000, and you had around 45 units in the shopping centre. In terms of rent collection over the past 12 months, this shopping centre has seen a rent collection of around 80%, which is well above the national average. So this is really quite appealing. Now, obviously, shopping centres inherently, because they are multi-tenanted, their risk profile is generally could be seen as a bit lower.
And Hodgie, how did pricing on Dumfries compare with Coventry when you look at it on the net operating basis?
Net operating income, it's the standard industry matrix to price off, and really between the two centres, very similar. Net initial yield spread between 15 to 18% between the two, and so we are starting to see a trend emerge.
So if you're happy with risk, that's quite attractive, isn't it? And if you think the market has bottomed out, so what's the buyer? Is he a big retail buyer?
Yeah, so the buyer in this instance, he actually specialises in offices, multi-let offices on a national scale. What he's done, he's decided to try a different region. He's gone into Scotland, and also a new sector, retail. And nothing like going into the deep end to learn how to swim, because he's gone straight for a shopping centre. But I think
he's a bright, brave chap with a good team around him.
Well, absolutely. But I think this is sort of part of the point. These buyers for this sort of kit, and the same goes for Coventry, they're seeking long-term income, return on investment. So, with shopping centres at the heart of many communities, it's a really, really attractive subsector.
And we've got a couple more in May, haven't we? So that's interesting.
And we have a few more in May.
So, Will, something a bit different. I think you were covering some of those banks.
I was working on the sale of a portfolio of properties let to Santander. That was on behalf of a major property company, and they range from Truro right up to Musselburgh. I think historically, bank income's been the real bedrock of private investor portfolio. They are on FR&I leases. There are 4 checks a year, and it's good to see portfolios in this sector come to the auction market again. Evidently, there is a change in consumer banking habits, but this hasn't really had any detrimental effect on investor appetite for the product. We sold just over £12 million worth of assets, 26 sales. The average yield on that 6.8%, down to as low as 4.8%.
And you got a few more contracts out there, haven't you?
There's certainly some bids coming in for some of the ones that still remain, and we'll hope to get a few more of those sold later this week. I think pointing out where pricing was strongest, it's not a new story. It's something that we've talked a lot about before, is where prospective purchasers see value in the upper parts. That's really drives pricing on. I could pick out the two larger lot size examples. Croydon at 1.65 million, or just over that. It's a lovely corner piece there with extensive upper parts. Very much a developer type buy given the location. We achieved £450 a foot for that one. Another one of the larger lot sizes was in Leamington Spa, 1.43 million, a slightly different buyer. It feels more of a family office type buyer, an attractive building, a well-liked town, and a popular high street. But there were upper parts there with long-term potential. And again, pricing on that one ahead of £400 a foot.
Okay, so no immediate plan to develop, but it's always there in the background. It's interesting. I was dealing with the Boots stores. We did 20 in this auction. We offered 20. We sold. I've just seen actually we've got most of them under offer now. So we sold 16 by the end of yesterday, right across the country, all dated back to a historic lease back in 2005 that Boots did on over 300 stores. Our client bought these 2 or 3 years ago and has re-geared the leases on 80%, 85%, I think. Boots have left very few of them. These leases yesterday were between 4 and 9 years left. Really good, solid pieces. Most of them had the upper parts intact. And again, adding a bit of value there in the longer term. I think one thing we picked up, and I'll probably get some stats out of account at some point, but a quarter of the towns were good staycation towns. And by that, I mean Looe, Hunstanton, Swanage, Kingsbridge, where people see these high streets being sustainable. These obviously Boots have stayed open throughout the pandemic. But these high streets have been busy, and we'll talk about the move out of town, out of the centres into these suburban centres or even staycation towns. They are busier. I know some investors are concentrating exclusively on those towns.
And George, I saw in the particulars that you published this time around a lot of the prescription information. Some of the numbers are quite staggering. Have you seen any link between number of prescriptions and pricing?
I think, it's very hard to know. Clearly, this data is publicly available. But I mean, Bridport, for example, 12,500 prescriptions a month. That's a lot of pill packages. And clearly, they're not all being picked up. Some are being delivered. It's sort of, we invented this. Someone invented the phrase clicks and bricks. But, you've got people going to pick up prescriptions. What Boots as a business probably make more money out of is high margin beauty products. So if you go and pick up your pills on a Monday morning, you can buy a couple of bottles of shampoo or something, suddenly the business is helped. So yes, I mean the prescription rates were higher in the more distant towns, and in the more southeasty towns they're lower. But of course in those wealthier towns they're selling more added value products. So I suppose the business makes more money.
Could be a trade off there.
Yeah, it's a trade off. 12,500 a month, that's a lot of business, and it keeps a lot of people busy. Ben, looking back at your sales, I think you were active in NatWest.
Yeah, absolutely. So just touching upon added value, this was quite a bit busy subsector yesterday in the auction. We sold out a portfolio of vacant banks, as you say, some vacant retail and light industrial units. But touching upon vacant banks, real highlight was in Reading, Marketplace Reading, 17,500 square foot former bank, sold for £2.325 million, reflecting £133 a square foot.
So now this was mostly vacant, wasn't it?
So mostly vacant. It had a little bit of a income producing shop downstairs, but majority was vacant. But this provided a buyer and the buyer the opportunity to come up with a new scheme. They got a blank canvas to work from. And
do you think clearly we have touched on it before, the new change of use policy that came into force last year, do you think that's had a positive impact on buyers on these sort of stock?
Yes, I do. So in September 2020, the planning use class system changed. It got rid of the old sort of A1, 2, 3, B1, D1 and D2 uses, and it bundled them all into a single use class, now known as Class E, Commercial, Business and Services. What it's done is it's given flexibility to buildings such as Marketplace Reading to be able to change between one use to another in this case, it will be mixed use. The buyer's looking to turn it into a bit of serviced offices, a bit of residential, and a bit of D1 use, in his case, educational use. So it will, a lot of that will come under this single new use class.
So it takes a bit of the planning risk out of a developer's game there, I guess.
Yeah, but I think that was the whole point of the change with the use class system. It was put in place to try and effectively to revive the high street. So it's put in place to increase flexibility for a lot of these buildings, so they can adapt to the changing environment.
Interesting. So, it's PDR on extension of PDR, which is 2013. It's really made a difference, isn't it? And it's allowed transactions to happen quicker and probably at better prices. Interesting, that one, Ben. I know that Reading had been on the market since November last year. Perhaps the market hadn't really adjusted to what this opening up of use classes could give it. It didn't sell then. It's obviously sold at a slightly higher price now, which is excellent. The market has clearly moved on and more optimistic. This theme of lots being offered before, interesting. It probably showed its head mostly in this building in Chepstow, a former care home in Chepstow, 52,000 feet on 9 acres is listed. No rent's been paid on it for 2 years. Receivers couldn't sell it last year, $1.25 million. We put it in the book at a lot less. And sold it yesterday for 1.5. So real result there. It just shows to shake up the market, give a bit of a deadline, and the same buyer was competing very hard, who had it under contract and paid quite a lot more yesterday. Okay, so Will, away from the high street, you're the alternatives guru in the team. Did you pick up anything which is kind of non-retail focused?
Yeah, the alternative sector is something we've talked about for a long time now, and I wrote an article on it back in 2018. I think it's probably best described as things you can't do online. It's important to highlight that the private investors and portfolio buyers are now much more educated in these sectors than they ever have been. They know how to assess the viability of tenants, etc., and are very comfortable in investing in these different sectors. They generally appeal as the leases are traditionally longer and often index linked in terms of rent reviews. So again, some chance for growth there. Just pick out a few examples from the auction. Philip had numerous funeral directors. Lot 20 was in Hedge End near Southampton. 9 years to Dignity Funerals, fixed uplift on the rent, a flat sublet on an AST, and there's underlying residential value for the site. That went 20% ahead of its guide price and achieved £600,000, which is sub 5% on a yield. Now, looking back even as far as 2013, yields on the better quality funeral directors have always been sub 5%, so there's been no real shift there. At the other end of the spectrum, Chris had a couple of nurseries that were both let to different variants of the Busy Bees covenant. He put those out a little bit early. Both leases had annual RPI uplifts. Contrasting assets and contrasting yields achieved in Eastleigh down towards the south coast there. This was 10 years unexpired. The tenant wasn't in occupation here, and the rent was at £35 a square foot. Now, it looks soft on a yield basis at 9.7%. But when you look at the capital pricing at over 2.1 million, that works out at £340 a foot. So I think that's the barometer on pricing on that one. At the other end of the spectrum, up in Bolton, this one was 18 years unexpired, the tenant in occupation, paying a rent of just £8 a foot. It's not much.
You had nearly 200 bidders for that, didn't you?
We had a huge amount of bids for that one. And it's nothing to look at in terms of the bricks and mortar real estate. But it was income that was the driver of competition here, and that achieved 5.6%. And I think all of these three, with the fixed rental uplifts or the indexation, are a real driver of demand from the private buyer. And I think that probably links to a lot of the convenience stores, George, that we've seen over the last 18 months or so.
Yeah, and we did 65 or 66 C-stores last year. Most of what we do is out in the regions, pubs with car parks and things. But this time, we've talked about added value today. We have one in Staines, which is a relatively decently new lease to Co-op, 15 years with kickers at 5. Just the ground floor of a resi development that's sold at just better than 5%, 4.7%, 1.52 mil. And also one in Brixton, Tom Hanson's local Sainsbury's with a bus stop outside. Just the ground floor again with a little bit of upstairs ancillary. Nice big piece, no added value, but a straight reversionary 10-year lease to Sainsbury's. Someone paid 4.7% for that, 1.942 million in strong competition, and you can kind of see why. It's probably equivalent of an annuity rate. It's been a Sainsbury's for 20 years, and it's going to be a Sainsbury's probably for a lot longer. So interesting, a bit dull in many respects, but that sub 5% threshold, it was met, and everyone is a winner. So gentlemen, looking ahead, what's going to happen going forward? We've had a decent start to the year with 2 good auctions. Ben, what are you most looking forward to?
Most looking forward to the 12th of April. It's in my diary. I'm looking forward to having a haircut finally and going to the pub, going to my local beer garden.
That leisure sector, well, we haven't seen much of it recently. You and I did a lot of sales in it last summer. It's going to have a kick, isn't it?
I think it's a sector that is going to thrive. There's a huge pent up demand from consumers, certainly to return to them. But also I think buyers in the market will suddenly see them as a viable opportunity again when they've been forced to be out of action for much of the last 12 months. Yeah,
clearly we wish the leisure sector well, and it does deserve an uptick. It's had a miserable 12 months, and I hope those businesses that managed to hang on really do get the uptick they deserve. It's hearsay, but the pub agents who are buying and selling business have been absolutely flat out as kind of new capital comes in and trying to hoover up some outlets, which is interesting. I know Wetherspoons are very acquisitive as well. So the 12th of April is going to be a great day. We hope. It's not here yet. Non-essential retail. Ben's getting a haircut. The town centre, city centre should be coming back to life. So wish you all well. Thank you for your time this afternoon. My name is George Walker. I've been joined today by Will Clough and Ben Hodge. Please do let us know what you think of the podcast at podcasts@allsop.co.uk. That's on our website. We look forward to your company again on the 7th of May.